buckled because it was like a $6,000 or $7,000 fluctuation. Right, it was up close to 18,000, John, 19,000, and then it went down to 10.4, and then it went back up to 16. And in fact, let's take a look and see where it's at right this moment. Well, right this moment, it's 16,099. I mean, what do you make of this, John?
Well, I think it's kind of a funny parallel with gold, actually. And in 2011, gold had its, bubbly run and peaked at about $1,900 an ounce. And then it took it 5 years to correct down to 1,100. Well, one order of magnitude higher, Bitcoin did the same thing in a week. It went up to 19,000 and then dropped to 11,000 before popping back up. So, we're living in internet time now, where the most bubbly assets tend to make moves that, used to play out over months or years in weeks. And so who knows what happens from here on out, because I think the Bitcoin crash of the past week probably spooked a lot of people, but when something is trending up, buy the dip is the dominant psychology. And that's what happened this time. People saw it drop and decided, whoa, okay, I didn't miss this after all. Let me get in now, and have pushed it back up. Again, who knows where this thing goes in the short run or the long run for that matter. But right now, the trend is back to being positive, which means we could see some big gaps up going forward. This thing moves in increments of $1,000 at a pop, which means we could finally break 20,000 this week, or another correction could set in. We could break 10,000. We just can't know with something that is still relatively small in terms of market cap, and where there's an immense amount of paper wealth out there that's looking for a safe haven. If you've got a stock portfolio right now, you've got to be kind of spooked because you've made so much money. You want to protect it somehow. Where do you go? Well, it seems like Bitcoin is one of the places where the money that people are taking profits in stocks. Look, who knows? Fun to watch, very difficult to speculate in.
Well, I wrote an article about it, and bubbles are all about, they deal with externalities, but you know what they're really about, John? They are really about dopamine and about dopamine transmitters. Dopamine is that thing that when you get a reward, it gets released into your system. And that's why when you accomplish something, you do something great, you get this high. And when you're in a bubble, there's no greater reward than flashing the screen and every 15 minutes seeing you made a couple $1,000s. And my whole point is the reason bubbles exist isn't so much because of external factors, although they certainly play a role. The Federal Reserve, what are they doing with interest rates, right? I mean, definitely it's a factor. But I believe when you get down to all of it, it comes down to dopamine. And dopamine, we all want it. We all are hooked on it because it gives you that euphoric feeling. And that's why these bubbles go so huge, blow so huge, and why irrationality really reigns supreme, if you know what I mean.
Oh, yeah. But I just think this is really unfair, what's been happening in the last few years, because short sellers deserve a little dose of dopamine too, right? I'll class myself as a short seller because I was really short at the end of the housing bubble. And that was such a rush to see these stocks that had just gone up and up and up, just find air pockets underneath them and just crash. Watching Citigroup fall to $3 a share was incredibly pleasurable. And, the short sellers of the world are waiting for that to happen again. And we think it's our turn. It's about time that stuff like Tesla and Netflix and Bitcoin start plunging so we can have a little bit of fun too, Fair is fair.
Yeah, well, I guess short sellers are entitled to their hit of dopamine as well, but lately they haven't gotten it like for years. Hey, well, so what about Martin Armstrong's contention that the market is going higher still. He's been right all along. He hasn't been right about the timing, because when I had him on 3 years ago, he said the market would double to 32,000 within a year. Well, we're 3 years later. It's closing in very quickly on 25K, which I think 25,000 is a very substantial number in a lot of ways, because it's a resistance point, a natural, round numbers are always big moments for the market, although they can be over importance put on them. But my feeling is that they do make a difference. When it hits 25,000, there's no resistance above it, is there?
Well, yeah, Martin Armstrong is a really interesting kind of outlier, because a lot of what you see now is valuation measures that show overvaluation in the market. I'm looking at a few right now where, if you look at trailing price earnings ratios, for instance, which have been a pretty good indicator of valuation for the market. In other words, when they get way out of whack, the market tends to crash, and they exceeded 45 in the last two bubbles, and then the market basically collapsed right after that. Well, now we're at 50 with trailing PE ratios, so that indicator is screaming, "Get out!" And it's been a fairly reliable indicator. And I've got another one here that's more obscure but also interesting, which is enterprise value for the S&P 500. In other words, what these companies are worth when you include their market cap, their equity market cap, and their debt, to free cash flow, which is the most important measure of corporate success that there is. And that's at record levels now, too. It's never been this high. In other words, corporations have never been this expensive before.
Yeah.
So looking at their success in the past and predicting big crashes, you got to be really worried. But then Martin Armstrong says that there's something different this time, and that is that the rest of the world is in even worse shape than us. And their money has to go somewhere when things fall apart. He thinks Europe is going to have a bond crisis pretty soon, where basically the Eurozone experiment fails. And there are trillions and trillions of dollars or of euros of capital that can move around the world when that happens. Well, where is it going to go? And his thesis is that it goes into U.S. equities because, we're relative to them in pretty good shape. China borrowed absolutely insane amounts of money for developing countries.
Yeah, China crisis now really went over the top. China is like, forget it. They have a money supply of 35 trillion now, right?
Yeah, I mean their debt quintupled in 5 years. That's something that no system can handle, in the sense that no system can productively invest that much new capital without just screwing it up, and buying things and building things that shouldn't be bought or built. And so their new millionaires really want to get their money out of the country, which is part of why Bitcoin has been soaring, because Chinese are using Bitcoin as a way to move money out of the country. And the Chinese government is reacting to that with capital controls, et cetera, et cetera. But, that money's going to get out if it needs to get out. So you've got these two very big systems that are in worse shape than us.
Mm-hmm. Yeah, much worse shape.
And so they see, IBM stock or Google stock or Amazon as safe havens, places where they put their money and have a reasonable degree of expectation that they'll get their money back at some point, and maybe even more than they put in. Whereas at home, they don't have that sense of security. So they're looking at us and seeing, these stocks as being richly valued, but still a better deal than what they've got at home. And Martin Armstrong, his contention is that that's going to give us one more big leg up in U.S. equity valuations, and that we shouldn't worry about these old indicators because they did their thing, they sent their signals in a different world. And today, there's no place else to go but U.S. equities. And so we're going to see them get much, much more expensive before they have their collapse, which will come, but it won't come right away.
Yeah.
That's an interesting thesis, and he's been right, like you said. So I don't know.
He's been right.
I don't know.
He has been right. Like in the final analysis, the theory underlying his prognostications, his forecasts might be subject to challenge, but in the final analysis, nobody that I've seen has called the market like he has. So
Yeah. Now, one other thing about this, though, is that in every cycle, there's somebody that seems to get it right. And they make a big name for themselves. And then they make an extreme prediction based on kind of the hubris that comes from being right a few times.
Right.
And they're wrong, and then they kind of fall by the wayside, And usually it's a technical analyst. There are a lot of big technical analysts who made predictions based on their charts, and then when they got famous and they made a big prediction on a global stage, their charts didn't work, and they're not really taking that seriously anymore. So the question with Martin Armstrong is, which one is he? Is he the guy who sees that it's different correctly? Or is he the guy who has made a few good predictions and then makes a big one and turns out to be wrong? We can't know this stuff until after the fact.
Well, the one thing, though, he's made a lot of predictions that have proved right in the past. A lot. He's not just a one-hit wonder like your bands from the 60s. He's been consistent, and his calls have always been controversial and always been poo-pooed by the mainstream, and yet he's been right way more than he's been wrong. So I'm not saying that it's going to happen this time at all. I don't know that. But the case that he makes for it, John, is pretty compelling. And combine that with his track record, and I wouldn't want to be betting against him, but many technical guys are saying that the market is at or close to a peak and expect increased volatility and, all sorts of bad things to happen to it. The other thing is, and I asked Charles Nenner this, he's another cycle guy. I mean, they're very close in their fundamental underpinnings. It doesn't mean that they have the same forecast. They don't. They're very different. But Nenner says everybody could be thinking that they have no alternatives, but the market could still go down. I thought it was like...
Kerry, approaching this rationally and in terms of valuation, you would say that gold and silver would be the big beneficiaries of this, right?
Right. Rationally,
because
we're not.
There are perceived as havens and down. You look at historical valuation differences between Google stock and silver, and if you assume that the world is going to shift towards safe haven investing in the future, you would say silver is a way better deal than Google, right?
Yeah.
Perhaps we can't know this again until after it's done playing out, but I think the dynamic that makes people buy Google and Amazon stock at these valuation levels ought to help precious metals to an even greater degree because they're more undervalued, but they're also historically successful safe havens in times of crisis. So you would think this would be a phenomenal environment for precious metals, and that the idea that the rest of the world is going to devolve into chaos and all the capital there is going to be looking for places to hide, that should be phenomenally good for gold and silver. The market's not behaving that way quite yet.
One would think, but the market always seeks to frustrate the majority of its participants, right? We agree on that?
Mm-hmm. Yeah.
And I think this is exactly a case where that's happened for a long time. And once the technicals get so bad for gold, which I think they have, and silver even worse, then all of a sudden it moves, and who knows what can happen? Who knows? It's a remarkable time to be alive and to be watching all this stuff, John, because...
Oh, yeah, Kerry, we're living through the most amazing stretch of financial history ever. And, it's going to end extremely badly. I don't think anybody that we watch, there aren't any... it's just a question of how does it play, how does that bad outcome happen and on what time scale and what goes up and down in the meantime? Those are the big questions. And those are important questions for trying to make money over the next 5 or 10 years, right? But I think you and I agree, and most of the people we talk to seem to agree that 10 years from now, things are not going to be good in the world. And the people who take steps to protect themselves now, even if it means missing out on some of the easy money that you get in tech stocks during a bubble, will be the ones who are the most successful and have the most capital at that time, but getting from here to there is really a difficult intellectual challenge right now.
Yeah, and it requires going against the conventional wisdom, requires you to be a contrarian, and there's a reason why contrarians aren't the major thought leaders, if you will. Well, they might be the major thought leaders, but contrarians by nature cannot be in the majority, John, right? They can't be because they're contrarians. If you're a contrarian by nature, that means that you don't believe what the herd is doing is correct. And, that can be a very profitable means of investing, but you don't want to be right at the wrong time because that is out and out dangerous. And that could be existential, an existential crisis for you if you're right at the wrong time. But I know I'm right. The market's always right. It's just the market can change its mind because it's fickle. So just because you think you're right doesn't make you right.
Well, if you watch the movie The Big Short, it chronicles some people who were phenomenally successful at investing for the bursting of the housing bubble. But they were only successful at the very end of the process for the few years that they were involved in that bet. In other words, betting that housing prices were going to collapse and the big banks were going to go down, their share prices were going to go down, and maybe they were going to go bankrupt. That bet worked out at the end, but for maybe 3 years, these guys were losing money, and their clients were pulling money out of their hedge funds.
Right.
Their face because obviously everything was great, and here they are betting against a system that's firing on all cylinders, and so this was a really traumatic experience for most of them. But in the end, they stuck with it, and they were successful enough to be profile Hollywood movie, right? But that's the way bubbles work. When you identify it as a bubble and you start betting against it, you probably have another couple of years or more before it turns out to be right, if indeed it ever turns out to be right. So far, betting against these bubbles that have been blowing up, at least since the gold and silver bubble of 1980, and then the junk bond bubble of the late 80s and the tech stock bubble of the 90s and the housing bubble of the 2000s, you were right to bet against all of them, but you had to get the timing right.
Yeah.
And if you were way too early, you lost your shirt because those things had parabolic increases in the year before they collapsed.
Yeah. Oh, yeah. So when you talk about The Big Short, they're like being cursed out by their investors. You idiot. You don't know anything, blah, blah, blah. And they said, just wait, you'll see. And then when it came, it was like, oh, I guess you were right. It was really funny.
Yeah, there's a really funny scene in that movie where after the collapse, one of the hedge fund guys who made a fortune after being yelled at for 2 years by his clients and everything, he made a fortune by hanging in there. And then at the bottom, he's buying equities. But one of his clients are calling him up saying, "Why are you buying equities? They're going down forever." So he can't win with his clients because he's always going against the tide, which is the correct thing to do, but it's always painful to do that in the moment, because the trends don't turn on a dime the way you wish they would. They continue for a while, which gives you a chance to get in, but you look wrong while you're doing it, and the people who are just looking at the trend and saying that that's the new normal, that it's always going to be like that, think you're an idiot. So you have to really have a strong sense of who you are to be able to invest against bubbles as they're expanding. And that's kind of what today is. We've got to get the timing right. If we want to short bubble assets and then make a fortune when the bubble bursts, we either have to get the timing perfectly, which is impossible, or be too early for a while and feel stupid. Those are your only two choices. And that's, I think, the way a lot of short sellers feel now. They've been going short for a long time. Mm-hmm. You look at John Hussman or somebody like that, who's a brilliant guy, but who's been negative about this market for several years.
Brilliant enough.
Yeah. And it just keeps on going up. Yeah.
Well, so then you look at Nassim Taleb's strategies here, John, which is make small bets with huge potential payoffs and keep making them, keep spreading them out. So as the next one expires, make the next bet. And it's worked for him in spades. So it's like the difference here is when you're at the table in Vegas and you're making the big bets at the craps table or the roulette wheel, what happens is that even when you win, you lose because you don't get paid true odds. On Wall Street, you're going to win because, and this is the beauty of it, you're going to win because you're getting paid more than the true odds, because there is no reliable method of measuring when these crashes are going to come and what their cost is going to be. So that's the beauty of it, that you can do it, but you need to really plan this out incredibly well. You need to be a pro, and in fact, you can get discounted odds because what you're betting on, it's just like if you were betting on Trump winning and you went to the odds makers. You can't do it in the U.S. because it's illegal, but they were paying like 50-1 odds. And in fact, Paddy's, the most famous turf accountant, that's what they call bookies in England, in the UK, paid off the bets early on Hillary Clinton. That was when I knew for sure that Trump was going to win, because it was nothing to lose there by doing it. But I knew that they had grossly mismanaged the book and they were going to pay the price. But they do have means of reinsuring their bets, if you will. So, but that was when I was absolutely sure Trump was going to win. When I saw Paddy's pay off their bets, I said, this is it. And sure enough. So it's hard to bet on the inevitable, but some type of crash becomes more inevitable, John, by the day, doesn't it?
Oh, yeah. But that, I've thought it was imminent for a couple of years now. So inevitable and imminent are the two things that you have to get right? You don't want to mistake one for the other. Just because something's going to happen, you don't want to bet on it happening tomorrow, because that's the thing you can't know unless you have some inside information. And right now we're in one of those stages, and these stages have happened in every bubble, where a lot of rational analysts decide that this is it. This thing has to blow up because it can't go any further. And so, in 1998, you go short tech stocks. Well, they double before the end of 2000 when they really crash, and you lose a fortune, and this is that time for short sellers. But it is going to crash. You can't have valuation levels like this be sustained forever, because it's you don't get a return on your capital, because that's what valuation measures measure. What kind of a return do you get when you buy $1's worth of a company's earnings? How much do you have to pay for that dollar, and over what time scale do future earnings pay you back on your initial investment? The higher the valuation, the longer the time scale in which you have to hang in there and things have to go right for you to get paid back. And we're at the point now where it's a really long time. If you buy the average stock in the S&P 500 right now, you're going to have to wait a really, really long time before the subsequent cash flows make it worth your while.
Absolutely.
And historically, that's not a good place to invest, because you want to wait till it goes down and then invest so that the cash flows pay you back right away. We're not in that time frame now.
Well, what Taleb says, and it goes to a little bit of statistics, but, we don't get heavily deep into the weeds on that. But what he says is that the players in the market basically are assessing risk in accordance with standard deviations on the table, so the bell curve. So what you are saying is going to happen is such an outlier, they can't possibly ever price it correctly. And then when it does happen, boy, it's hallelujah time, because maybe the odds of happening it were 1 in 100, but your bet is paying off 10,000 to 1. So you've made 100 times more than what was the risk that was priced into the system. I mean, there's a very simplistic explanation of it, but that's really the way it works when you get down to it, is you're getting better than house odds. And that's why, but It's not like the gambler's fallacy, which is if I keep doubling my bet, eventually I'll win money at the table. That's called the martingale system. Just keep doubling your bet. As you lose $1, bet 2. Lose again, bet 4. Bet 8, bet 10, bet 12. Eventually you have to win, but actually you're doubling it. So you lose 8, bet 16, 32, 64, 128, blah, blah, blah. This is different because the event that you're betting on virtually has to happen, right? It has to happen. It's just that the time premium, right? Because when you're buying an option or you're buying out in the future, you're paying a time premium, right? But because that time premium is so underestimating the risk in the market, that's how you make a fortune at it. But you have to plan this out and spread the money out. Ordinary investors, you can't do it. All you could do is hope to go to a fund that is doing it and that the fund doesn't go bankrupt before the momentous day happens. I mean, what you said about the Big Short and the players there, the immense pressure they were under, and finally the guy just suspends all distributions, withdrawals from the hedge fund and says, no, you're in this, you're not getting out. And they freak out and they threaten to sue him and everything else. But within a couple of months, it all works out. And we're going to have this at some point. Of that, there's no question. Even Martin Armstrong agrees. The only question is when. So you need to make a 2 to 3 year horizon if you're going to play this short, because it could be 2 to 3 years, John.
Well, that's how it's worked out in the past. You hit a valuation level that screams bubble, sell your stocks and then turn around and short every stock you can. You hit that level, and then it goes on for another 2 years, and equities double from there. Which is the nature of bubbles. They get irrational and they have a parabolic blow off at the very top and everything. So if you're just looking at historical valuation measures, you're too early. Now, you could make the case that that point was passed 2 or 3 years ago based on current valuation measures. In other words, we're at the point now where the guys who got in 3 years ago or shorted the market 3 years ago should be getting their reward. But we've got this whole foreign capital inflow thing that is fairly unique. It hasn't happened in the past at the peaks of bubbles. So that's a wild card. Plus, we've got the world's central banks with unlimited printing presses who are just sitting out there waiting to buy equities in the case of a market correction. They're terrified that the system won't be able to handle a garden variety bear market. A 20% drop in equities is something that happens all the time.
Good for the market. And
it's like a small forest fire. It has a very useful function in market-based economies. But the governments of the world are afraid that small forest fire this time around is going to turn into a global conflagration that just basically wipes out the existing systems. So they don't want to let that happen. So you have several things that are unique this time around. Foreign capital flows, you've got governments with unlimited printing presses, and you've also got the willingness of corporations to borrow money at zero and then buy back their stock in a really aggressive way that we've never seen on this scale before. So you've got a lot of new stuff that might change the calculus for equity valuations and for bond valuations.
And don't forget, we just had a tax bill passed that encourages and will no doubt increase the very behavior that you're discussing. One thing I wanted to cover about that tax cut is the repatriation provisions. Now, there's a misnomer that somehow that money is in a big lockbox overseas. Stranded U.S. corporation profits, $4 trillion worth, is sitting in a lockbox like your Social Security contributions are in a big lockbox, so it'll never go broke because we put in so much. Another issue, but it's sitting $4 trillion in a lockbox. And therefore, people, the companies will repatriate the money, and that's going to be a good thing. And it will for tax collections because there's a 15.5% discounted repatriation fee for that money. So they're definitely going to do it. But the reason they're doing it, John, has nothing to do with the money being here nor there. It enables them to put the profits back into the company, pay a discounted tax rate, and thereby lower a liability on their balance sheets for deferred taxes, because they figured the taxes in at 35%. Now they're only paying 15.5%. So that is, plus they get to deduct the foreign taxes that they paid, which nobody ever talks about. So that greatly reduces the actual 15%, cuts it way down. Point is that where do they put that money now, John? Do you know where they put it? Into treasuries. They buy the treasuries from their overseas subsidiary, or they open up Apple Ireland Inc., opens a bank account at JP Morgan Chase and puts all that money in there and gets whatever investment deals Chase provides to multi-billion-dollar depositors. That's what's happening to the money. It's not like it's not here. So the idea that it's going to somehow be invested in the U.S. and it's not already is a misnomer. But it does have the potential that they'll pull it out of treasuries once it's here, because why have it in treasuries, right? There's no reason to have it there. And that could affect interest rates on the point there. But when you got that much money, you got to put the money someplace. Bonds seem like a very rational place to put them, right?
Yeah. And I think if you give corporations more money to play with, we also know that they're going to buy back a lot of their stock, because that's what they've been doing with corporate profits over the last few years. And that kind of financial engineering does lead to, other things being equal, higher share prices, but it leads to huge amounts of new leverage for companies. So to the extent that they have new cash coming in from a lower corporate tax rate, although they don't really pay the top marginal rate now, so it's not clear exactly how much money they get. They will take a lot of that and buy their own stock back, probably.
Yeah, to some extent. They will share the wealth a little bit, because it's going to be horrible PR for your average multinational company. Like, for instance, AT&T. They have an effective tax rate in the 30+% range. So their profits were somewhere around $7 billion last year. So their taxes are going down, like they're getting back over $6 billion. Assume their profitability holds up for next year. So $6 billion, if they didn't do things for their employees and just went on an M&A spree, man, you would just have people howling. Especially now they want to buy Time Warner Cable, and Trump doesn't want them to. So by giving out $1,000 pop bonus to a couple 100,000 employees, really makes them look benevolent and public spirited. They're really doing what's best for the country, blah, blah, blah. But this is more than just being good guys. It's being good guys, getting credit for it in the hopes that Trump will approve their upcoming merger with Time Warner, which Time Warner owns CNN. We all know that Trump has some issues with CNN, right? I mean, do you see the beauty of this, John? Like, managing public perception. But nonetheless, those people got are getting $1,000 ahead, and nobody can complain about that, right?
Well, I think they would complain if they understood how the accounting works, because corporate M&A, in other words, when one company buys out another company using extremely cheap debt, that has the same effect as corporate share repurchases. It's just a company buying another company's stock instead of buying their own stock. It has the effect of raising the valuation of corporate assets out there, which enriches the corporate class in general, right? And that's another thing you see at the peak of cycles. You see companies buying themselves or buying each other out to build empires. And usually the peak of the cycle acquisitions turn out to be a really bad idea. So I think the same will happen now. These big M&A deals that we're seeing now will be quietly unwound at the bottom of the cycle, because that's how it always works. And everybody's looking for the AOL Time Warner deal. In other words, the big deal that rings a bell at the top of the cycle. And who knows, maybe this is it.
I think it's it.
Basically the same assets in play.
I think it's it. I think, it's totally deja vu all over, John. To quote or paraphrase the late, great I think he died, Yogi Berra. In any event, hey, that's it for this week. We've run over our time.